Warren Buffett, the legendary investor and sage of Omaha, is revered for his timeless wisdom and unparalleled success in the world of investing. His strategies and insights offer invaluable guidance, especially when it comes to making the most of spare cash within your investment portfolio. Let's delve into Buffett's expert strategies for investing surplus cash to maximize returns and achieve long-term growth. If you've recently got a raise, tightened your budget, or received a financial windfall, you might have more money available. People in this situation often ask themselves, what should I do with extra money to improve my financial situation? The first thing to do is pay off any high-interest debt, such as credit cards. If you're in debt, paying it off will free up more monthly money and help you avoid costly interest charges. Buffett underscores the significant burden high-interest debt places on financial stability. Debts with exorbitant interest rates, such as credit card debt or high-interest loans, not only drain financial resources but also hinder wealth accumulation due to escalating interest charges. Buffett's famed quote, "Compound interest is the eighth wonder of the world," underscores the transformative power of compounding in wealth creation. While compounding can work in favor of investments, it works against those bearing high-interest debt. Buffett advocates prioritizing the repayment of high-interest debt. He recommends allocating surplus funds toward eliminating high-interest debt, as the interest accrued often exceeds potential investment returns. This strategy frees up financial resources and accelerates the path to financial freedom. Another thing you should do is to boost your emergency fund. Your emergency fund should have enough money to cover your living expenses for at least 3 to 6 months. An emergency fund isn't an investment, but it does help protect your investments. With it, you can avoid needing to dip into those investments when faced with emergency expenses. Buffett stresses the need for individuals to establish a financial safety net. Emergency funds act as a cushion during unforeseen circumstances like job loss, medical emergencies, or unexpected expenses, preventing individuals from resorting to high-interest debt or liquidating investments. Buffett highlights that relying on investments for emergency situations might disrupt long-term investment strategies. It provides peace of mind, allowing individuals to navigate through challenging times without compromising long-term financial goals or succumbing to panic-driven decisions. After sorting out your debt and emergency fund situation, it's time to start looking into investing your spare cash and making your money work for you. One of the cornerstones of investing is using the power of index funds, something which Warren Buffett swears by. He believes that most people should own a cross-section of businesses that in aggregate are bound to do well. The simple way to do this is to invest in an index fund. Here's how Buffett's favorite index fund could make you a millionaire. In his 2013 letter to Berkshire Hathaway shareholders, Buffett recommended that most investors put their money in a low-cost S&P 500 fund. He even noted this in his will, where he instructs that 90% of the cash inherited by his family be invested in such a fund. An S&P 500 index fund meets Buffett's advice about owning a broad range of businesses. These funds invest in the 500 large-cap companies that comprise the S&P 500. Those companies represent 11 different sectors and 24 industries. But there are quite a few S&P 500 index funds available. Which is Buffett's favorite? He has provided 2 big hints. First, Berkshire Hathaway's portfolio includes 2 S&P 500 exchange-traded funds, the SPDR S&P 500 ETF Trust and the Vanguard 500 Index Fund ETF. Second, Buffett mentioned in his 2013 letter to Berkshire shareholders that he suggests Vanguard. Based on these 2 hints, there's a strong argument to be made that Buffett's favorite S&P 500 index fund is VOO. That's not surprising, considering it has a very low expense ratio of only 0.03%. By comparison, SPY's expense rate is 0.0945%. Buffett told Berkshire Hathaway shareholders roughly a decade ago that any investor who owns a large, diversified basket of stocks via an S&P index fund is bound to do well over time. He was right. It's possible to retire as a millionaire by investing in VOO. For example, assume you invest $5,350 annually in this ETF for 30 years. If the S&P 500 delivers the same average annual return of 10.7% as it has over the last 30 years, you'd end the period with a little over $1 million. The low expense ratio for VOO would be acceptable with your total returns. Taxes could be a factor though. However, investing in a tax-protected account such as an IRA or a 401k would solve that problem. Of course, there's no guarantee that the S&P 500 will deliver the same level of returns in the future as it has in the past. However, even if the returns decline somewhat, making $1 million by investing in a VOO is a realistic goal for many individuals. However, Buffett didn't make his fortune by socking away money in an S&P 500 index fund. He invested in individual stocks. Buffett has also offered sage advice for anyone seeking to follow this different path to becoming a millionaire. He and his longtime business partner, Charlie Munger, treat buying stocks like they do in buying entire businesses. They try to estimate the earnings potential for the company for at least 5 years into the future. Then they determine if the stock price is reasonable compared to that projection. If they feel uncomfortable with estimating earnings, they move on. Allocating spare cash into stocks presents an opportunity to potentially grow wealth and enhance the performance of your investment portfolio. But before you buy your first stock, there are some rules that you need to keep in mind. And what better investor to learn these rules from than Warren Buffett himself? Buffett is a long-term investor and believes that it is more important to focus on the future potential of a company rather than its short-term performance. He invests in companies with a durable competitive advantage, strong management, and a history of growth, and he holds on to these investments for the long term. Taking advantage of the power of compound interest, he has said that his favorite holding period is forever. Buffett believes that it is essential to have a deep understanding of the industries and companies you are investing in. He takes the time to thoroughly research each investment opportunity, looking at factors such as the company's financials, competitive advantage, and management team. By following this rule, he is able to make informed investment decisions and minimize his risk. Warren Buffett doesn't invest in junk. You typically won't see him buying struggling businesses, regardless of how cheap they become. One of the best Buffett quotes new investors can absorb is, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Utilizing spare cash to buy stocks enables investors to seize opportunities presented by market fluctuations. During market downturns, stock prices of fundamentally sound companies may dip, providing a chance to acquire shares at discounted prices, potentially yielding substantial returns as markets recover. Investing spare cash into stocks aligns with the objective of long-term wealth accumulation. Historically, stocks have outperformed other investment avenues over extended periods. This approach allows the spare cash to potentially appreciate in value, bolstering the overall growth of the investment portfolio. Investing spare cash in stocks allow investors to harness the power of compounding. Reinvesting dividends or capital gains back into stocks can accelerate wealth accumulation as earnings generate additional returns, compounding over time to amplify the overall portfolio value. Warren Buffett's strategies for investing spare portfolio cash serve as a guiding beacon for investors seeking to maximize their portfolio potential. If you found this video interesting, don't forget to hit the like button and subscribe for more content like this. Thanks for watching.